Greetings everyone, Sergey Yakimov here, and I'm delighted to delve into a book that has profoundly shaped my investment philosophy. Benjamin Graham's The Intelligent Investor. Now you might be wondering, why this book? Why does it matter? Well, in a world awash with fleeting financial advice and get-rich-quick schemes, Graham's wisdom, much like a sturdy oak, has stood the test of time. This book isn't about market tricks or timing the next hot stock. It's about building a durable framework for investment decisions, a framework rooted in logic, discipline, and a long-term perspective. Think of it as your financial compass, guiding you through the often turbulent seas of the market. Over the next few minutes, I'd like to share 5 key takeaways from The Intelligent Investor that I believe can be immensely valuable to both seasoned investors and those just starting their journey. So, let's dive in. Imagine, if you will, owning a piece of a business. Let's say a bakery that consistently churns out delicious bread. This bakery is known for its quality, and customers line up every morning to get their hands on the freshly baked loaves. You take pride in being a part owner of this establishment, knowing that your investment is in something tangible and valuable. You paid a fair price, $1,000, for your share of this bakery. It seemed like a reasonable investment given the bakery's reputation and consistent performance. Now, every morning a fellow named Mr. Market shows up at your doorstep. He's there without fail, rain or shine, always ready to make you an offer. He's a bit of an eccentric character, prone to wild mood swings. One day, he might be cheerful and optimistic, while the next he could be downcast and full of doom and gloom. Some days, Mr. Market is exuberant, downright giddy, convinced your bakery share is worth $2,000, even $3,000. He can't contain his excitement and is willing to pay a premium for your share. He waves fistfuls of cash, eager to buy you out. His enthusiasm is infectious, and you might be tempted to sell at such a high price. Other days he's gloomy, pessimistic, whispering that the bakery is doomed, offering a paltry $500 for your share. His negativity can be disheartening, making you question the value of your investment. Here's the crucial point. Mr. Market's valuations are often driven by emotions, by fear and greed, not by the bakery's actual worth. His offers fluctuate wildly, not based on the bakery's performance, but on his own erratic feelings. The quality of the bread hasn't changed, the bakers are still skilled, yet Mr. Market's pronouncements swing wildly. The bakery continues to operate efficiently, producing the same high-quality bread day in and day out. This, my friends, is the stock market in a nutshell. Prices fluctuate, often dramatically, influenced by a torrent of news, rumors, and sentiment. The market's mood can shift in an instant, causing prices to soar or plummet. Prices fluctuate, often dramatically, influenced by a torrent of news, rumors, and sentiment. But amidst this chaos, it's essential to remember the underlying value of the businesses you're invested in. But the intrinsic value of a business, its true worth, is far more stable. The bakery's value doesn't change overnight just because Mr. Market is feeling particularly euphoric or despondent. Graham's genius lies in recognizing this distinction. He understood that the market's daily fluctuations are often irrational and that true investors should focus on the long-term value of their holdings. He urges us not to be swayed by Mr. Market's daily whims. Instead, we should remain calm and focused, ignoring the noise and concentrating on the fundamentals of the businesses we own. Instead, we should focus on understanding the underlying businesses we own, buying when prices are irrationally low and selling when they're irrationally high. This approach requires patience and discipline, but can lead to significant rewards. Remember, in the stock market, you're not just buying tickers and charts, you're becoming a part owner of businesses. Treat it as such. Take the time to understand what you own and why you own it. Don't let Mr. Market dictate your investment decisions. Stay informed, stay rational, and most importantly, stay focused on the long-term value of your investments. Now, not everyone has the time or inclination to become a deep-dive business analyzing investor, and that's perfectly all right. In fact, many people have demanding jobs, family responsibilities, or other interests that take up their time and energy. For these individuals, dedicating hours to studying financial statements and market trends simply isn't feasible. Graham offers a path for the defensive investor, someone seeking a sound, steady approach without needing to become a Wall Street wizard. This approach is designed for those who want to invest wisely but prefer a more hands-off strategy. The cornerstone of defensive investing is diversification. By spreading your investments across various asset classes, you reduce the risk of any single investment, significantly impacting your overall portfolio. Don't put all your eggs in one basket. This age-old adage holds true in investing as well. Diversifying your investments helps protect against market volatility. Instead, spread your investments across a mix of stocks and bonds. This balanced approach ensures that you have exposure to the growth potential of stocks while also benefiting from the stability of bonds. A 50-50 allocation is a good starting point, though you can adjust based on your risk tolerance and age. Younger investors might lean more towards stocks, while those nearing retirement might prefer a higher bond allocation. When it comes to stocks, Graham recommends sticking with large, established companies with a solid track record of profitability. These companies, often referred to as blue-chip stocks, are typically more stable and less volatile. Think blue-chip companies with a history of paying dividends. These dividends can provide a steady income stream, adding another layer of stability to your portfolio. Avoid chasing the latest fads or speculative investments. These can be tempting, but they often come with higher risks and can lead to significant losses. Remember, the defensive investor prioritizes safety and stability over quick riches. The goal is to build a portfolio that can withstand market fluctuations and provide consistent returns over time. One of Graham's most enduring principles is dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, you avoid the pitfalls of trying to time the market and instead benefit from the long-term growth of your investments. By doing so, you buy more shares when prices are low and fewer when they're high, averaging out your cost over time. This method helps smooth out the highs and lows of the market, making your investment journey less stressful. The beauty of defensive investing lies in its simplicity and effectiveness. It's a strategy that doesn't require constant monitoring or complex decision-making. It's a strategy designed to weather market storms and deliver steady long-term returns without requiring you to be glued to your trading screen. By following these principles, you can build a robust portfolio that supports your financial goals with minimal stress. Chapter 3. For those with the time, temperament, and intellectual curiosity to delve deeper, Graham offers the path of the enterprising investor. This path is not for everyone, but for those willing to put in the effort, it can be incredibly rewarding. This approach requires more effort, more research, but it also holds the potential for greater rewards. The enterprising investor must be diligent, constantly seeking out new information and opportunities. The enterprising investor, as Graham envisioned, is like a detective, meticulously searching for undervalued securities. They must be thorough in their analysis, leaving no stone unturned. They pore over financial statements, analyze industry trends, and assess management quality. This detailed analysis helps them identify companies that are truly undervalued. One of Graham's key metrics for identifying undervalued companies is the margin of safety. This concept is crucial for minimizing risk and maximizing potential returns. This principle involves buying stocks trading at a significant discount to their intrinsic value, their true worth. By doing so, the enterprising investor ensures a cushion against errors in judgment or market downturns. Think of it as buying a dollar for 50 cents. This analogy highlights the potential for significant gains when the market eventually recognizes the true value of the stock. The enterprising investor is also a contrarian, often going against the prevailing market sentiment. They are not swayed by popular opinion but rely on their own thorough research and analysis. They're willing to buy when others are fearful and sell when others are greedy, capitalizing on market inefficiencies. This contrarian approach can lead to substantial profits when executed correctly. This approach isn't for the faint of heart. It requires a strong resolve and the ability to stay calm under pressure. It requires patience, discipline, and a willingness to withstand market volatility. The enterprising investor must remain focused and not be swayed by short-term market fluctuations. But for those who persevere, the rewards can be substantial. The journey of the enterprising investor is challenging, but the potential for financial success makes it worthwhile. Chapter 4. Let's talk more about this margin of safety idea because it's central to Graham's philosophy. Imagine you're about to cross a bridge. Would you rather it be designed to handle precisely the weight of your car, or would you prefer one built to withstand 10 times that weight? Of course, you'd choose the over-engineered bridge. It provides a margin of safety, a cushion against unexpected events or miscalculations. Investing, Graham argues, should be approached with the same mindset. We rarely have perfect information about a company's future prospects. Unexpected events, economic downturns, or competitive pressures can all impact a business's performance. That's where the margin of safety comes in. By buying stocks trading at a significant discount to our estimate of their intrinsic value, we create a buffer against these uncertainties. Even if our analysis is slightly off, the margin of safety helps protect our investment. Think of it as a financial safety net, providing peace of mind and reducing the risk of permanent capital loss. Chapter 5. Now you might be thinking, this all sounds great, but investing is about numbers, right? About analyzing financial statements and crunching data. And while those are certainly important aspects, Graham emphasizes something equally crucial: temperament. The most brilliant financial mind, armed with the best research, can still falter if they lack the right temperament. What do I mean by temperament? I'm talking about emotional discipline, patience, and the ability to think independently. The market is a master manipulator of emotions. It can lure you into buying during periods of euphoria and scare you into selling during moments of panic. But the intelligent investor, Graham reminds us, doesn't react emotionally to market swings. They stick to their principles, buying when prices are attractive and selling when they're not, regardless of the prevailing market sentiment. Remember, investing is a marathon, not a sprint. It's about making sound decisions based on logic and reason, not being swayed by the fear and greed that often grip the market. As we conclude our exploration of the intelligent investor, I hope you come away with a deeper appreciation for its enduring wisdom. This isn't a book about getting rich quick. It's about building wealth steadily, prudently, and with a margin of safety. Whether you choose the path of the defensive investor or the enterprising investor, Graham's principles provide a timeless framework for navigating the complexities of the market. Remember to focus on the underlying businesses you own, seek a margin of safety in your purchases, and cultivate the right temperament for long-term success. Thank you for joining me on this journey through the world of the intelligent investor. May its wisdom guide you in your own investment endeavors.